So, welcome everyone. Thank you all for joining us once again for our webinar series where we bring in industry experts to give us invaluable insight and wisdom on various topics related to real estate investing. My name is Sohail Hassan, and I am the managing partner at MarketSpace Capital, a private equity real estate development company headquartered out of Houston, Texas. And I'm, of course, joined by my fellow co host and the Honorable Chairman of MarketSpace Capital, Dr. Masaki Oishi, affectionately known to all of us, of course, as Mas. Welcome, Mas.
Thank you, Sohail. It is my pleasure to be here.
Well, my job today is to facilitate a discussion between you and our guest speaker for this evening, Mr. Josh Plave, the founder of Wall to Main, and of course, a full-time multifamily investor himself. And I'll tell you, we've had a lot of requests from our existing investors for this month's topic because, one, I think that it's something a lot of investors don't really know about, nor is it they even know it's an option. And two, people think it's a complicated topic and just don't want anything to do with when it comes to your IRA or self-directed investments. So we've gotten a lot of questions from some of our investors, which we're going to definitely answer tonight. But some of them are, how can I leverage my IRA or 401k to invest in these multifamily syndications? What are the right type of accounts to use when investing in multifamily? And of course, the all-important question of what are the tax implications that you need to be aware of when using your self-directed IRA. But at the end of the day, investors should know about these tools that are just there for them to use because after all, why would you allow your capital to earn only 8% and be exposed to the volatility of the market when it could be earning well over 15% or more and be fully backed by a real asset?
Well, Sohail, that's exactly right. And this, of course, is a topic that's important to our audience out there, many of whom include physicians just like me. And they know that they need to begin planning for retirement and their savings, but they just don't have the time or the ability to plan that far ahead. It is a well-known fact that most physicians have substantial earning capacity, whether they're general practitioners, orthopedics, or neurosurgeons, but generating a six-figure income does not always translate into the creation of substantial wealth in the long run, nor does it give physicians the freedom to reduce their workload or to focus on retirement. Speaking from personal experience, while studying and practicing medicine, I always look to invest strategically. And I have a long history of seeking out and performing due diligence and investing in real estate assets. Having learned from the struggles and adventures of my real estate investing, I now seek to share some of these tips with you so you can take your income and invest in real estate and generate substantial alternative income from these investments, not only during your career, but also in retirement. And I think today we've brought in the perfect expert to speak to this because, as I understand, our guest speaker this evening has been investing with his family, and his experience in retirement accounts began at the age of 16 when he opened his first Roth IRA and began trading equities. Since then, after the unfortunate passing of his grandfather and mother, he was left with multiple inherited IRAs. Through careful research and structuring, Josh has been able to further the legacy of prior generations and accelerate the growth of his family's capital. This experience led to the creation of Wall to Main, where the lessons learned and opportunities found are meant to be shared free of cost for those who seek to preserve and grow their wealth for a prosperous future. Josh is, of course, a regular on the podcasting circuit where he shares his story, in addition to the little tips and tricks that are invaluable to investors when choosing to invest in multifamily with their retirement accounts. Now, investing with his family, they hold a portfolio of over 700 units across three markets. And we are very lucky to have him here with us this evening to share his knowledge on this topic. Please welcome Mr. Josh Plave.
Welcome,
Hey,
Josh.
thanks for having me. I'm just gonna real quick. Unfortunately, my internet's been a little wonky, so I have to cut my video. Unfortunately, but still here in spirit and voice. So I just like to start usually with like a kind of a thinking exercise where I ask people, where do you think the two largest sources of wealth are for the average American? I mean, the first is the equity in our homes, and the second is actually in your retirement accounts. Nearly all of us have them, but few people actually know how to effectively leverage their largest investable account. So today we're going to go over how to use your retirement account to invest in real estate. Now, the mission I had for Walter Main came from a conversation I had with my dad 3 years ago. He was right on the cusp of turning 60. He was starting to plan for retirement in the next few years, and the 401k plan he plans to lean on is it's doing great. He's invested in a variety of broad market mutual funds, ETFs. The market's at an all-time high, and things were looking good. But my dad, he didn't really plan on retiring right then and there. He knows he has another 5, maybe 10 years in him. So we're just kind of starting to work out how to ease him out of work and transition into retirement. But the concept just really wasn't clicking. He was worried about his investments. By the time he needed his 401k funds, he was worried that the market might not be there for him, and neither would his account balance in the end. No one really wants to pull from their 401k when the chips are down, right? So this is kind of the reality for so many families across America. Just like my dad, you might be afraid that the stock market won't have your back when it comes time to retire. So I built Walton Main, which aims to help investors like everyone here how to use multifamily to de-risk their portfolio and build a better future. So you might be wondering why a 30-year-old guy is up here talking about retirement accounts. As Dr. Oishi mentioned, I started when I was 16 years old. My mother and grandfather were both kind of forward-thinking CPAs. They said I should really, put my money to work that I had earned that summer into a Roth IRA. So I've been investing in equities since then. Um, and I got my start through, in self-directed retirement accounts through the inherited IRAs that they left us. And it wasn't really a life-changing amount of money, but it was enough that I needed to determine how I was going to preserve everything and make sure that everything that they had worked for over the course of their lives was preserved and accelerated into the future. And so what resulted from there was a lot of learning from many, many places. Many of the sources that I found in the retirement space ended up being heavily biased. Almost all of the education in this space is done primarily by custodians who really hope to get you interested enough to open an account with them without you really knowing what options you have beyond just them. So I'm here to give you the full picture from an investor's fellow investor's perspective. Now, naturally, we'll start with the basics. This is really your chance to diversify. You probably have already figured this out, but you can invest in virtually anything you like with your retirement accounts. There's really just three limitations. The first one is you can't invest in collectibles like art, jewelry, cars, alcohol, things of that nature. You can't purchase life insurance policies, and you can't own shares in S corporations. But beyond these three things, any investment you think is fair game is perfectly viable for your retirement account. So the only hitch is that custodians, such as the one you see here, or the few that you see here, they don't really facilitate anything beyond equities, stocks, bonds, things of that nature. And so you need to find a custodian that allows for alternative assets and and investment vehicles that you maybe would want to move beyond just the ones that these custodians offer. And to do so, you need to have what I like to call control. What I mean by this is it needs to be in your possession. It cannot be with a current employer. If it is with a current employer, they need to allow for what's called an in-service rollover. Most typically don't allow for this kind of transaction. Some do, so it might be worth checking if this is your case. But typically, we're using accounts that are from previous employers or from accounts that you maybe have opened up yourself outside of your employer. So before you start wheeling and dealing, you need to learn a few rules. Um, Strictly, there's no current benefiting from your account. What I mean by this is that your retirement account can't benefit from your actions, and you cannot benefit from the actions and investments of your retirement plan. This leads us directly into participation. You cannot have any active participation in an investment that your retirement account has made. What this means is let's go down to something as simple as just buying a house that you plan on flipping. If you plan to buy a house to flip, you totally can in a retirement account, but you cannot go in and swing a hammer. You can't put in anything that's considered sweat equity because your retirement account would be benefiting from your actions. And into multifamily, this means you cannot actually invest your retirement account into any deals that you are a general partner on. You have to be a limited partner in a multifamily investment. And that bleeds into the income side of things. Anytime that you are actively earning income on a property and helping your retirement account at the same time, that's a disallowed, prohibited transaction. So it means that all income needs to be from passive activities. Because of this, I like to say you need to think of your retirement account like it's another person. So keep this phrase in mind. We're going to jump back to it in a little bit. But let's first discuss the people that you can and can't invest with when using your retirement account. So the concept here is a disqualified person. We'll first start with interaction. The answer here is none. Zero, zip, zilch. You can't interact with your retirement account. And this goes in both directions. Or for that matter, for your disqualified person's retirement account. You cannot invest in the same deal that your retirement account is investing in uh, if a disqualified person is investing in it, or if a disqualified person is using their retirement account and you plan on using just cash, that unfortunately is not allowed either. When it comes to assets that you want to buy, you can't do any of the following. You cannot buy a rental property with your retirement account and rent it to a disqualified person. If you were to do this, the theory behind this is that you could either give your disqualified person a very favorable rent it to them for $1 a month, and they could benefit from that, or they could rent it out for $10,000 a month and push more money into your retirement account. You can't let someone stay in an Airbnb that you own with your retirement account, even if you're allowing them to stay for free. And you can't buy a property with your retirement account and then sell it to a disqualified person because you could give them a favorable sale or they could give you a favorable sale. And so when it comes to co-investing, you really cannot invest in any deal that they are managing themselves or any deal that they are investing alongside you with. Now, the nice thing is there's a little caveat here, and it works within multifamily because multifamily syndications, as long as it's a syndication, it's a security. You're buying shares in a security. It's the same as if you were to invest in, let's say, Apple. If you were investing with your retirement account and a disqualified person was investing with just cash, that obviously wouldn't be an issue. But when it comes to syndications, that's also not an issue either. But when it comes to just any kind of non-syndicated real estate, that's an issue, and you need to make sure that you're not investing side by side with a disqualified person. So let's take a look at who are disqualified people. So this is the family tree I like to show. Anyone in dark blue is a disqualified person. These are linear ascendants and descendants as well as spouses. Anyone in light blue, like siblings, aunts, uncles, cousins, in-laws, those are all perfectly fine. You can invest alongside them. Now, obviously, these are a lot of the first people that many of us would consider investing with. So it seems pretty restrictive, right? Well, there's kind of a way we can get around this. If you recall from a few slides ago, I said think of your retirement account like it's another person. Well, that same thing goes for any of your disqualified people as well. Their retirement accounts are different people too. And those retirement accounts aren't disqualified. So this means you can actually take the family tree that we saw previously, and as long as everyone is involved using only their retirement funds, you can turn your family tree from this into this. And this is actually what I do with my family. We built a holding company. We've pooled our retirement funds together to get into more deals at once and meet minimums on a smaller personal level. Let's say that you have an investment minimum that's $75,000 and there's three of you. You can get in for only $25,000 each, allowing you to be invested in more deals, further diversifying your retirement from there. If you like that little trick, I have a few more for you. So feel free to text the word top 10 to the number 66866, and I'll be happy to send you the top 10 tips and tricks when investing in multifamily with your retirement account. All right, so let's jump into what accounts are available to you. There's really two different kinds. As an investor and not a custodian, here's what's been my experience. Custodians are by law not a fiduciary. They are not required to look out for your best financial interests. So, in other words, they tend to look after themselves. They hit you with plenty of fees, and the fees themselves then grow as your investment brings in more and more returns and they have more assets under management. So not only are they expensive, but they're also very slow. Um, Much of the time, approval for a deal is really just a compliance matter for custodians. You have to send in paperwork every deal, and this can take weeks. And I've actually seen it prevent my investors from transferring their funds in time. There have been a few instances where approval just took too long. Our investors lost their spot in the deal because paperwork was being delayed and they didn't get their funds in on time. So instead, I like to advocate for what's called checkbook control. It's lesser known, but it's extremely powerful. Me and all of my investor friends and partners use these types of accounts, and I believe they are truly what enable you to make the most of your existing retirement account. So let's take a look at this method a bit more. With checkbook accounts, you really have two options. So just to keep things at a very high level, um, anyone, including non-US citizens, can open a self-directed IRA up. Um, it does have a lower contribution limit. Now, the solo 401k, that requires self-employment income. Just to cover the basic ground rules for it, generally speaking, you cannot have employees in the associated business. Spouses are perfectly fine, but anyone working more than about 500 hours per year is going to disqualify you from establishing this account. Now, I want to kind of pause briefly here and mention something for this specific audience. Let's say you have your own private practice in which you're earning self-employment income, but you also employ a few individuals that would, of course, disqualify you from opening a solo 401k. Now, if you were to have a separate business as well, let's say it's a consulting or an expert witness business that was, entirely unassociated from your practice. Now, unfortunately, you still couldn't sponsor a solo 401k at that business either. Having one business with employees unfortunately disqualifies you from sponsoring plans at other businesses as well. But on the positive side, this account does allow for a much greater annual contribution, as we can see here. And these aren't including catch-up limits or catch-up amounts if you're over 50 years old. And it also benefits from incurring absolutely no taxes when investing in multifamily. Unfortunately, the self-directed IRA can't say the same, but we'll get to that in just a minute. So let's just take a look at it structurally, how these types of accounts work. For a checkbook control IRA, what you're going to do is you're going to open a new self-directed IRA up at a self-directed IRA custodian. You'll transfer in old funds from a previous IRA or 401k. At the same time, your provider will also open up an LLC and fund that LLC with the money from the new custodial account. You'll 100% own the LLC just as you do any other business, and you can open up a bank account like any other business. And that LLC can then directly be managed by you and invest in investments where the expenses and the income will flow in and out of the LLC itself. For a solo 401k, looks a little more complex, but it's actually even simpler. You just have the solo 401k itself, and everything goes from there. So there's two ways to provide money and get money into the account. There's one from the business that is sponsoring it. You can provide contributions from the business, as well as rollovers from previous accounts that you had to sponsor and fund the solo 401k. And from there, you have direct control of the investments. You can invest via the solo 401k itself, and then you can see the expenses and income flowing in and out of the solo 401k, not to you. To you, there are distributions and 401k loans, as you would see with a typical 401k at an employer, except you're the employer here. Now let's see how you can fund these accounts, the rollovers, what types of accounts can move from one to another. Now, if you have a Roth IRA or an inherited IRA, unfortunately, those two types of accounts are locked and they can only be moved directly into a self-directed IRA. If you have a traditional IRA or a 401k of Roth or traditional amounts or monies, 403b, a TSP if you're in the military, any of those types of accounts are perfectly free to move, and you can actually move those into a self-directed IRA if that's all you're eligible for, or a solo 401k of either Roth or traditional varieties if you can sponsor one of those. And so, why would you want to roll over to a solo 401k? Well, as I mentioned previously, this type of account avoids taxes, which come into play when investing in multifamily with your retirement account. So let's say that we buy this apartment building with our IRA. We'll say that in the top half with 25% equity and 75% leverage on the bottom half comes from an outside lender. Portion in light blue was funded by our tax deferred dollars from our IRA. And that portion of income is never taxed. It's derived by our own equity in our tax deferred account. But the portion of income that's derived by the leverage, by the outside dollars that didn't come or weren't derived by our retirement account, the income that comes from that is considered unrelated debt financed income, or UDFI. So you earn UDFI and ultimately you have to pay what's called unrelated business income tax, or UBIT. And so the nice thing here is that even though you have to pay taxes on the leverage portion, the leverage portion can actually make it you can use its share of depreciation, operating expenses, interest expenses, any other type of loss. And so in this example, we'd be able to use 75% of all of these types of losses to help offset UBIT. And so the question here is, how bad is UBIT? Now, a lot of people make this out to be this bad boogeyman. They instill a lot of fear. They kind of they make a lot of their living off of swaying people away from UBIT to then sell certain types of accounts. And I wanted to answer the question, really, how bad is it? Not just a vague understanding of the concept, but really a concrete answer to what kind of an impact there would be uh, as a result of UBIT. And so I actually built the real estate industry's first UBIT calculator, where I can take the expected performance and returns from a multifamily syndication and see what the expected taxes will be. This now allows me to go out and look for deals that result in the smallest taxation impact for my investors. So let's take a look at what the typical impact of UBIT will look like. This isn't the prettiest spreadsheet, unfortunately, but this is really an example of a typical property that we invest in. This is a property we actually closed on 2 years ago. There's a lot of numbers here, obviously, but the two lines you should focus on right now are lines 3 and 5, labeled member cash flow. And so that's pre-tax income. And then line 5, UDFI taxes, or UBIT. And that is your ultimate tax penalty. And so what you can see is that, and what we've found is, on most deals, the losses that you're able to use tend to offset enough of your income for about the first 3 to 4 years. Either, in this example, it was $0. In other examples, it's minimal. It's a couple $100s. It's nothing really impactful. But the big bill comes, as you can see, in year 5, when we have almost $30,000 in taxes that we need to pay. And this comes because of a capital gains event. And so I wanted to take a look at the impact of this over, the over the lifetime of an entire investment. And so if you take a look at the tab on the bottom right that I've added called UBIT reduction, you can see how it annualizes out. And what we've found is that most deals will typically see a reduction in annual returns of about 4 to 6%. So on this deal, we were returning almost 23% to our investors. And after UBIT, it gets knocked down to about 17%. So I still consider it to be a worthwhile investment, something I was happy to purchase with my investors. And as you can see with IRR, which obviously takes into account the time value of money, you see an even lessened reduction via UBIT. And that's because if you take a look above, we have a refinance in year 3. So in year 3, we're able to return about $61,000, or 61% of an investor's initial capital. And that situation is not a capital event. And so you're able to get more money back in your hands and invest into another deal, let's say, before UBIT taxes are ever seen. And so that's really indicative of the type of account that we like to go after. So obviously this isn't optimal, but the question is, how can we get around UBIT? And so there is one small trick you can use that will ultimately have a fairly large impact to your investment. Let's say you have a self-directed IRA, you funded it with traditional, obviously non-Roth money, but you don't have self-employment income. So you aren't currently eligible for a tax-free option. You could invest in a deal right now with a self-directed IRA. At some point down the line, before a capital event occurs that would ultimately trigger UBIT, you can earn self-employment income. So You can do some consulting work on the side. You could just sell items on Etsy, whatever it takes to establish a consistent business that you yourself are operating. And at this point, you're now eligible to sponsor a solo 401k for that year. So you can open that solo 401k up and you can then initiate an in-kind transfer. They're really pretty easy. You'd still be invested. The investment will just sit in a new account. It'll go from the IRA over to a solo 401k. And if you do this prior to the asset being sold and incurring a capital event, you'll then be able to avoid all UBIT taxes. So keep this in mind as a trick you could potentially use, but the only hitch is that you need to make sure that you have self-employment income each year that a solo 401k is open. Or if you don't, you'll have to close down the account within 12 months and transfer the money back into a self-directed IRA. So if you don't like paying taxes, there's your key to avoiding UBIT. Again, if you like that little trick, I have even more in my free PDF, the top 10 tips and tricks when investing in multifamily with your retirement account. Just text the phrase top 10 to the number 66866. I'd be happy to send it to you. And that's about all I have for you guys today. I would be happy to take any questions.
Fantastic, Josh. Thank you so much. That was great presentation and kind of introduction to this topic. So we have some questions coming in, and Dr. Oishi, I'll let you kind of take the lead in fielding these questions as they come, and as well as if you have any questions yourself, feel free to ask. You're on mute, Dr. Oishi. You're on mute. You're still on mute.
I'm sorry. Can you hear me?
Yes, we can. Fine.
Wrong. I was going to say I'm just stunned by the amount of knowledge and pearls of wisdom that have been shared with us just in this one presentation, and so very generous of you, Josh, to let us in on these things. I appreciate that.
Yeah, thank you.
And yeah, in terms of questions from our audience, let me just tee up what we have available here. All right. Our first question, let's see. How does the investment work from a tax perspective? Does the money continue to grow in a tax-free environment like stocks until I take it out? If so, I assume no K1.
Yeah, so there's two pieces to this.
Right?
The first is that all retirement accounts are issued K1s. You receive those from the sponsor themselves, and you ultimately end up filing for an IRA. You'd file a 990T, and that's the way you report the income as well as any losses that you could potentially use. And then it also includes the leverage, the average leverage that's used for that year on the investment to indicate what your leverage share is that you can ultimately use to offset. Yeah, so it does continue to grow in a tax-free environment, just like stocks. If it's in an IRA, you do pay taxes each year that there is any kind of taxable event that we've talked about. But when it comes to traditional money, yeah, it earns completely tax-free aside from UBIT, and then when you take it out, you pay income taxes on the distributions, and if it's Roth, you ultimately don't pay anything on the distribution. So it grows tax-free beyond UBIT, and then you just take it as distribution money.
Because a Roth starts with already post-tax money. Is that what you're saying?
Exactly. Yes.
Okay. Our second question, I guess this is a little more specific. If I have $150,000, can I spread it out amongst multiple investments, or does it all have to be invested in one deal?
Yeah, it operates just like cash. You can invest it as many ways as you like.
When you're setting this up,
Okay.
Josh, through a custodian, what are the fees that you're seeing typically on these? Are they standard across the different custodians, or what do you see?
They really aren't. There's really two different types of fee structures that I've seen typically. I'll start with custodians. They operate either on the total account balance. And so let's say you have about $200,000. I think that's It's fairly typical for high income earners. You're looking at somewhere between um, two and $5,000 a year in fees. Sorry, two or five or $700 a year in fees, and so it starts to add up. And then as you continue to, and that's not just funds that they currently have on hand. That's your overall account balance. And so if you, let's say you invest in a few different deals, and you end up growing your funds, and it goes from 200 to 400 over a couple of years, you're going to look at an increasing amount of funds, and the schedule of fees doesn't really tend to stop. And then you're also open to a different structure. There's the structure of number of assets that are owned, and so you're looking at something like $200 to $400 per asset that's owned. If you have three or four different investments, you're looking at something beyond $1,000 a year. When it comes to checkbook accounts, there's a couple of different options, but they typically can start as low as $300 a year, and then they're not based on the overall account balance. It's just the admin fees to file some year-end paperwork, and so you're looking at something around $15 a month, maybe $150 to $180 per year, and then you really just incrementally you pay the wiring fee as opposed to paperwork costs and transaction costs.
Gotcha. Yeah, we've seen a variety of different one. I mean, we have investors that use Quest, Community National Bank, a variety of different services. Are there any in particular that you can recommend in terms of like what you've seen as reasonable on the fee side that we can consider in the future?
Yeah, absolutely. I have generally two companies that I work with that I suggest for two different types of investors. If you're the type of real estate investor who likes to be creative and dabble in a few different types of asset classes. Maybe you do some limited partnerships. Maybe you also do some joint ventures, and you like to do some single family and Airbnbs and stuff like that. And you just want somebody to kind of guide your hand through each transaction, making sure that each one is allowable, and you just kind of have some checks and balances in place. I use a company called Safeguard Advisors. Uh, they are a full service. They'll set up the LLC for you. They'll set up the custodian account for you. It's not held with them, but it's held at a different custodian. But they ultimately are there for you as an advisor in perpetuity. And so if you have any questions, you can go back to them. That one's about $1,000 to start up, maybe a little more than that. But the nice thing is it's $135, I think, annually to continue. The other one, if you plan on just passively investing and you kind of have one investment type, it's your bread and butter, and you don't really need ongoing advisory help. I like to use a company called Rocket Dollar. Rocket Dollar is an all online streamlined process, fairly simple, and they're the ones that I mentioned that are about $310, um, and they will be, I think, $15 a month going forward.
Fantastic. So we have some other questions coming in right now. And before we get to the next one of the investors actually had asked if you could please resend the text, the number that you were talking about, Josh, where they can receive the tips. If you don't mind bringing that up one more time.
Yeah, absolutely.
There we go. So texting top 10 to 66866 will get you the top 10 tips and tricks when investing in multifamily with your retirement account.
Yeah, this seems like a tremendous bargain, Josh. You sure you want to give this away for free?
Yeah, I've found that providing, as you are probably finding with these webinars, providing the education up front is it's key to engaging some trust with your investors.
Well, that's true. I agree with that.
So we had some other questions that came in. Dr. Oishi, are you able to see them on your end?
I'm having a little bit of a technical difficulty. Would you mind reading
Sure.
out for us? Yeah.
So one of them was asking, can you use your solo or self-directed IRA for your own active investments? He answered that at the very beginning, and Josh, that was a resounding no, correct?
Yeah, exactly.
Okay, excellent. And then another question that came in is, do all custodians offer this, or are there specific ones? And you had mentioned some, but I mean, as a general rule of thumb, do all custodians, if you kind of went to them, would they offer this particular type?
So it depends on what you're Googling. If you search custodians and you're looking up, your Schwab's, Vanguard's, Fidelities, they will not. They'll be very confused and not understand what you're trying to do. If you're looking up self-directed custodians, then yes, virtually any custodian will allow you to invest in real estate. It's the most common investment type for self-directed IRA and 401k invest or custodians. There are some that place some limitations, like they don't have the ability to trade cryptocurrency, but real estate is one that is unanimously available at self-directed or alternate custodians.
Great, thank you. One of our investors is asking that his TSP is split between Roth and traditional. Can they be combined when opening a solo or SDIRA?
So yeah, they could. You would have to. Uh, you can transition the traditional into Roth, and you just have to pay the taxes as income that year. It's not a disqualifying or early withdrawal penalty of any sort. It just the traditional amount that you're converting over to Roth gets added to your overall income at the end of the year.
Fantastic. On when we're looking at our IRA in terms of a custodian, is there, in terms of the client services side, is that an important aspect in terms of customer service? What do you see as far as kind of the long term?
Yes, absolutely. This is one of the keys here. If you do plan on going with a custodian, I would highly suggest that you check into some reviews of their customer service. There are a few that are notoriously known for kind of pumping the most marketing dollars into the space. They're kind of the behemoths that you might see, and they're the slowest ones I've come across. They're the ones that we end up finding it just takes 5, 6 weeks for them to process simple paperwork. It's not very complicated when you have a syndication to put on the paperwork. There really aren't going to be disqualified persons involved in that transaction, yet they still somehow have a long time to process that. Um, when it comes to checkbook control accounts, uh, it's not as much of an issue. It's maybe an issue if you're trying to fund it very quickly and you're trying to establish that account as rapidly as possible to get into an investment that you just found. I would highly suggest for most retirement investors that they do this ahead of time because it can take anywhere between 2 and maybe 4 or 5 weeks to roll over the funds.
Mhm.
Depends on how on top of it with paperwork you are. But yeah, once you've established that account, if it's checkbook, ultimately you're the one who ends up pulling the trigger. I like to my phrase is you can find a deal at breakfast and fund it by lunch. If that's your vetting time, you can fund it as quickly as that.
Wow, that's fantastic. Okay. One of the questions that was coming in, and I thought it was fascinating when you were talking about pooling your family's money together, your family and friends. Can you talk a little bit more about that process, and then do they all need to either be solo or self-directed IRAs? I mean, what does that look like for you to actually implement something like that?
Yeah, I mean it's pretty simple. There's they do have to they all have to be retirement accounts theoretically, unless they're not disqualified persons. Like for example, my sisters, they're not disqualified persons, so I could create a holding company with my retirement account and put in their cash as well. So that wouldn't be a problem. But if you start mixing in maybe let's say your parents or your children, it needs to be just your retirement accounts. It can be 401ks, IRAs, whatever you'd like. And if you still want to hold some stocks as well, you can also bring in typical, normal accounts that aren't self-directed. As long as they're all retirement accounts, it keeps it pretty simple. It's pretty streamlined. You just open up an LLC. You have your lawyer run up a operating agreement for all the um, different members, and the members would be the actual retirement accounts, not yourself.
Mhm.
And they just keep track of all the ownership shares.
Got it. Okay. The UBIT calculator, that was really cool. And, I appreciate you kind of putting that together. One of the questions our investors were asking if that was publicly available, and if so, where they might be able to find it.
Yeah, this is something I'm struggling with, to be perfectly honest. It's a behemoth, ugly spreadsheet that lives in my computer, and it requires 58 different inputs into it to run. And so typically, it's run by syndicators, folks who have all the varying details on the pro forma for each individual year and different expenses and income amounts. So I'm trying to find a way to provide a simplified version of that as well as a a streamlined version that I can hand out to syndicators. So unfortunately, it's not publicly available currently. The only way it's really being disseminated out is on each individual investment that I provide to my investors. I provide the expected returns as well as expected retirement taxes.
Yeah. Okay. Yeah. Really cool stuff. I mean, we'd love to get our hands on something like that. And like you said, making it more user friendly. There might be something to that. Obviously, there's a demand for this particular product, and I can tell you from our end at MarketSpace Capital. I mean, I've never really looked at a model that's really taken into consideration and gone down to that level of detail. So very impressive stuff, Josh. That's great. So let's see. The last two questions I have here. I guess this one question, Josh, and in terms of the projects that you're doing, what percentage of the equity that you're funding is coming from self-directed IRAs or a solo IRA at this point?
Yeah, let's see. On a personal level, it's the vast majority of my accounts. The vast majority of what I had available was through, inherited IRAs, and so that's it was maybe 70 or 80% of what I've invested in. That's why I built the UBIT calculator originally for myself. With my own investors, it's around that same number as well. The nice thing is when you have a deal that works from a let's say positive UBIT um, outcome, maybe something that's minimal UBIT impact, that's also going to translate into a great opportunity for cash investors as well, because it typically is something that is maybe going to be a lower leveraged, lower risk. It's going to be something that has higher returns to begin with, and even if you take a UBIT impact, you're still seeing positive returns. So still have some cash investors as well. It's just, yeah, it's, I would say, more heavily towards the retirement side.
Yeah, great. And the final question, Josh, at least from my end, in terms of our discussion this evening, one of our investors was really kind of going or asking for you to go into the concept of seeing your IRA as another person. And I kind of got the point from the way you're treating that. And there's a couple of specific points that you made in terms of how it can help you or it can hurt you. Could you kind of go over that one more time for us?
Yeah, sure. So the reason I kind of came up with that phrase was to illustrate the fact that you have disqualified people. You're the first disqualified person, obviously. But then there's also people like your parents and your children and your spouse. Um, so they're disqualified. But because the retirement account is, let's say, a different entity or a different person, that account is not disqualified. So you can interact, your retirement account can interact with their retirement accounts. And then from a perspective of, you know, a lot of people like to ask me, well, if it's depreciation, unused depreciation, if we're not using some of the depreciation, can I make use of that? And the question is, I mean, can you use, the average Joe's depreciation down the street? The answer is no, it's his to use. It's your retirement account's depreciation to use. If it's allocated to your solo 401k, you don't ultimately have to use any depreciation because there's no tax impact, but you can't use any of that depreciation. It's a paper loss. It's phantom losses. It's then phantom loss to the universe. It's no one gets to ultimately use it, and so you kind of need to think of those two things separately. Income that comes in and out of the retirement account, it doesn't go to you. It flows directly into the retirement account. If you want to take distributions once there are funds in the retirement account, you certainly can, but you can't take anything directly from that investment to yourself. Just as if somebody was investing in an investment themselves, you couldn't take their returns. It has to go to them, and they have to cut you a check if you have that kind of a deal. So just keeping them as separate as possible, in my mind, is the easiest way to understand things.
Yeah, no, it makes complete sense. So that's all we have from my end. Josh, are there any final comments or final questions from you, Dr. Oishi?
Oh, I mean, I'm still just blown away by how much I've learned today in just this one seminar. I think it's really amazing how much information we packed into this short period of time.
Really, and Josh, we're so thankful for you to joining us this evening, and I know that your wife is pregnant and she's expecting soon, and so for you to take some time to join us really means a lot. So, any final comments or anything from your end, Josh?
Not at all. Thanks for having me. I really appreciate it. I'm glad we were able to do this.
Of Of course. And as a reminder to everyone, we will, of course, provide a recording to this that we will email out to all of our investors tomorrow, along with a copy of the slide deck as well, if you're interested. On behalf of myself, Sohail, and MarketSpace Capital, thank you all for joining us this evening. Dr. Oishi, if you don't mind just closing us out.
Yeah, absolutely. I want to thank all those in our audience as well for the insightful questions that were made. And of course, very special thanks to Josh for being here today and helping us better understand how to utilize self-directed IRAs for real estate investments. Your insights were truly invaluable. I don't know, why you give it away for free, but that's another matter. Once again, we do appreciate you all for taking the time to join us. And on behalf of GRI Multifamily and BPR, yeah.
Thank you. Thank you, guys. Appreciate it. Thank you all. Wish you all a good evening. Thank you. Take care. Bye-bye.